All right, so welcome back to the next segment where I'm going to value Berkshire Hathaway. So starting off on the top page here, you can see that one share of Berkshire Hathaway is just $270,000. And as we go through this, you're going to see why it's such a high price. Here in the summer of 2017, I briefly mentioned in the last segment or the last video that the market was priced at a PE of 30. You can quickly see here that Berkshire Hathaway's price to book, you can see their forward PE, you can see that that's 22 is what they're expecting off the future cash flows. I personally really don't like the forward PE. I like just the straight PE a little bit better. You can go down here, you can look at their price to earnings here is a 20. Basically, they're saying for every $20 that you spend buying this company, you get $1 as earnings a year later. So let's go into the key ratio and kind of see what Berkshire Hathaway looks like. So the first thing that we're going to look at is the top line. And you can see that Berkshire Hathaway's top line is just growing like crazy. It just keeps on going up, just like Tesla. The difference, though, is when you look at the bottom line, which is the profit that the company's making off of those revenues, they just keep going up as well. And that's a very, very good thing. And that's something that you'll typically pay a premium for. But what you're going to find very surprising is that the premium isn't anything like the premium on Tesla. It's much, much lower, which is good. So that all looks fantastic. These are nice, stable growths. If we plot those on a graph, which we're going to eventually do here with the free cash flow, you're going to see that it is very stable. In fact, let's go ahead and do that right now. So if we come down here to the free cash flow, that is the actual cash being generated through the business. That's the number we like. That's the operational income minus the capital expenditures is how you figure out what the free cash flow is. But what's nice with Morningstar is you can just take the data right there. We're going to copy that. And then we're going to go over to our Excel spreadsheet with our intrinsic value tab. And we will plot that right here on the top. We just pasted that in there. And you can see the free cash flow of Berkshire Hathaway is going up. So if we would slide down and we'd look on this example, I've dove straight into the numbers. I've gone straight into the intrinsic value without even really having to do anything else. But I will go back to that and I will look at some of those things. So I have a ton of trust in Berkshire Hathaway. I've gone to the shareholder meetings. I'm comfortable with the managers, Warren Buffett and Charlie Munger. Those are people that we trust. They have a track record of decades of experience running the business. So when you think through all of those things and you think through the stability factor, see these arrays that we're looking at? You can see that the free cash flow is plotted there. You can see how 5% is pretty close to a match. Maybe 7% might be a better fit for the trend line. Yep, it looks like 7% is a pretty good trend line. And then the top, I would make this tighter because I have so much confidence in Berkshire Hathaway. Now, some people might say that Warren Buffett and Charlie Munger are old, so there's going to be a change in management that could create chaos or whatever, and they might make the bands wider. That's completely up to how you want to make this assessment. I'm going to say 12%, and that even seems a little high. I'm going to go to 11%. And then for the lower band, I'm going to say, let's say 4%. That seems a little high. Let's go 2%. That seems reasonable. So let's put these bands right there. I've got a lot of confidence. I'm going to put 70% into this one. And I'm going to say 15% here and then 15% here. Okay. And so now that's 100%. And now what's going to happen is you're going to look down here and you're going to see what the projected free cash flows of Berkshire Hathaway would be. Now, we got to go to the last section here, the number of shares outstanding. And believe it or not, I think it's 2. Let me just double check. 2 shares. See how the share count is really low? That's why you're getting such a high number on the market price. So let's go ahead and put 2 in here. And the current market price, and you can see if you could buy Berkshire Hathaway for $370, your expected return is 2,834%. So now you can see why we've got to put in a much higher number. So we'll go ahead and put that in here. 1, 2, 3, enter. And when we do that, and my calculator to the cell needs to be expanded because Berkshire Hathaway is such an expensive stock, you can see that the IRR, the expected return, is 4.4%. So that shows you fantastic business, fantastic managers. The market's expensive, so you're only going to get 4% return buying it at $270,000 a share in the summer of 2017. Or at least that's what we expect, assuming that these free cash flow estimates that we're making are correct projections and that this actually happens. If they come down and they go lower, then you're not going to get 4%. You're going to get much lower than 4%, maybe even negative. Those assumptions are so important, but what helps is finding a stable business. So let me explain to you why investing at certain points in time are so important to doing this well. So if you go back to 2009, 2010, you would have saw that the price on Berkshire Hathaway was significantly depressed. It was way down. You would have been getting returns here well in excess of over 10% based on running a very similar model. And it would have been very easy to invest in a business like Berkshire Hathaway, either the A shares or the B shares, and you would have got a tremendous return during that period of time because the price was so depressed. Buying it right now, you're getting a 1% return higher than what the S&P 500 would give you based on this model, based on what our expectation is. So when you're thinking through that and when you're making this assessment, you can see how all this kind of comes together. And you can see how when Stig and I are on our podcast and we're saying everything's overpriced, everything, we're complaining, we're whining because these prices are so high. You might be watching this video in the future after a stock market crash, and you might be putting some of these numbers in and you're seeing really high returns. And that's a result of the market contracting, the credit cycle contracting, and you being in a very advantageous time. So you can go in here to the competitive advantage tracker. You could, change this to BRK, and you could enter the revenues. We could do the same thing where we could look up Berkshire Hathaway's. Let me just do it to kind of demonstrate to you. You go to Google, type in BRK 10Q, and the first thing that comes up is their 10Q. We'd go into the second quarter of 2017. We'd look at the PDF file. And we just go down until we find the income statement here, the consolidated balance sheet and consolidated statement of earnings. Okay, so here's the revenues. So insurance makes up $45 billion of their top line. The railroad makes up $9.8 billion of their top line. Financial products, they make up $57 billion of their top line. This stuff is great for you to go in here and enter this so you can see the plot. You can see what this looks like. Their competitor is going to be a hard one to fill out because there's not too many businesses like Berkshire Hathaway. Then when you go in here and you start filling out their competitive advantage, you can talk about the size, the cash position. I think the cash position on Berkshire is, close to $100 billion in cash. That's an advantage. That gives them flexibility to maneuver into the future if things go bad. So each one of these things you could fill out. We give you a lot of tools and checklists here to go through to make those qualitative assessments. And what those qualitative assessments are used for is when you go back to the intrinsic value and you're making these estimates of where this is going to go, this is where you're matching the qualitative and the quantitative in order to come up with this bottom line estimate. You might actually say, because of all this moat that he has around his business, I think they have an even higher probability, so I'm going to give this 30% instead of 15%, and this would be 0. I mean, you can do stuff like that, and then you're going to get different numbers on your expected return. See, it went up to 5%. All right, so I know that one was really quick, down and dirty, but a lot of the reason it was so quick was because it's a really stable business. Everything in there checks out. They don't have tons of debt. They're making tons of free cash flow. All that stuff makes the assessment a whole lot easier to do. So I hope that one was interesting and valuable for you as you think through the way that you're going to assess a business. The two that I highlighted were probably on the extreme limits. I had a really high growth company with Tesla that, has a lot of concerns moving forward, whether they can do things, they're borrowing tons of money, but we were still able to figure out a way to determine some type of value or what we thought the return might be at the current market price. As these businesses change and as these market prices change and they go up and they go down, you're going to see that your expected yield will change with those values that you enter into this cell. And as you make different assessments onto which way the business is going to be able to continue to earn, that's going to change your assessment on what the business is worth. So I hope all this has been very useful.